My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. Ever since I was a new dividend investor, I was always so curious to see how different people invested in a similar strategy as my wife and I. My wife and I, we both work full-time jobs, we're in our mid-30s, and we ideally don't wanna be in the rat race for our entire lives. We wanna have flexibility and freedom to do what we want with our time, and we really kind of discover this whole concept of passive income and, making money while you sleep. In theory, it sounds great and almost too good to be true. And as I started learning more and more about this concept, it got me really excited. And I ended up creating this YouTube channel. Been doing this for the last couple, 3 or so years now. And I love this series here on the channel because I get to see how different people across the globe are investing in a similar strategy. But yeah, that's enough about me. So today's video, we're gonna answer a subscriber question. We're gonna go ahead and we're gonna take a look at 3 portfolios. The first is from an 18-year-old here in the US, a 32-year-old from Brazil, and a 35-year-old from the US. As always, everybody, the timestamps will be in the description below, as well as the portfolio links. And as always, I'm not a financial advisor. Don't take what I'm saying as financial advice, just merely for your entertainment. And as always, everybody, I don't pre-review or pre-record what I'm going to say here. I'm looking at the portfolios for the very first time. So, as a lot of you following the channel, a lot of you are new to investing. I actually try to skew what I say in my content towards newer dividend investors. I try to kind of think of myself in mind when I first started investing. What were the questions that I had? What were the struggles that I had? And I try to tailor my content towards that audience. But what I found was that, when I first started investing, I had so much confidence for whatever reason. I didn't know everything, but I had so much confidence in what I was doing. But then I later realized that what I was doing was not actually ideal given, my time horizon and things in my life changing. But I was thinking back on how I used to be when I first started investing, thinking that I knew everything. And, that expectation that, when I started investing, I thought that I had all the answers, but in reality that I didn't have all the answers and I was actually a complete noob. But yeah, the expectation of me knowing everything when I first started was definitely off. The reality when I first started investing looked very different, and it kind of looked a little like this. Oh my gosh. So I think I mentioned like on every video, I'm pretty weird and I'm a nerd. I like to let that shine through. I very much love being unique and different. I don't want to, copy anything that anybody else does. I am my own individual and I embrace my weirdness. Anyways, if you want to embrace my weirdness and your weirdness together, I'm going to try to be a little bit more active on social media. I've been a little bit more active here on Instagram. If you're on Instagram and you want to connect, go ahead and give me a follow there. And there's a ton of finance accounts on Instagram. My account will quite literally just be random memes that I randomly think of. So I know there's a lot of personal finance Instagram pages that take it really, really serious and want to give financial advice. Yeah, that's not what you're going to get here. So, but yeah, if you're interested in that, and if you kind of share my quirky humor, then it might be something fun. We can maybe connect here on Instagram. I'll leave a link in the pinned comment. You can check it out there if you want. So I want to answer a question that I got here on one of my YouTube videos a couple of days ago. And I think it's a really timely question because I just shared an entire video on a dividend reinvestment calculator. And there was one point in here that I didn't cover that this person is asking, and I may have an answer that might help you out here, plant-based cyclist, and everybody else out there that maybe is in a similar boat. So the question that you're asking here is related to the most recent video that I made on the dividend calculator. So he writes here, thank you for your videos. I've learned so much from them. I just watched the video on the math behind retiring early with dividend investing. So it's actually just playing around with your dividend growth calculator. And I have the numbers that I need to hit for the amount of dividend income I'm seeking in a few years. I know that there are many ways to hit the numbers with different combinations of yield growth rates and current yields. But once I find the numbers I need generally, what have you found to be the most efficient way to find possible investments? An example, if I'm attempting to find investments with a current dividend yield of 5% and a dividend growth rate of 6%, what is the most efficient way to find them? I have very little experience with Seeking Alpha, but can learn it or any other platform. Again, thanks for the videos. So this is a really great question. I covered everything in that video except for this. I actually didn't cover this topic on how you can screen and find dividend stocks that meet your time horizon. So I want to answer that here in this video really quick. So first off, I want to share with you the way that I used to do it, and I'm going to show you a better way today. So when I first started dividend investing, I would go on sites like suredividend.com. I love them, by the way, not affiliated with them. I love the research that they do. The majority of everything that they do is free. I just access their free content. They have lists of different things here, you know, the dividend aristocrats, the dividend kings, et cetera, et cetera. So you could do it manually through this. You could also go to like dividend.com. The issue with dividend.com is a lot of the features that you would need, they require you to pay. Like they don't have a lot of free versions. 3 years ago, I was using dividend.com the majority of the time for all of my research, but now like they don't really show you anything unless you pay. And I don't really think that that's very cool. So I have actually been using Seeking Alpha really just exclusively. Now, I've used Seeking Alpha for about 3 or so years now, and I love it because you can access almost everything that you would generally need as a do-it-yourself investor. But they also offer other premium services and other things like that. But I love their site because they still provide enough content that you don't have to pay if you don't want to. Right? So that's really what I would say to that. But to answer your question on how you can find this, you really just need a screener, a stock or ETF screener. Now I've done, you know, a ton of Google searches. There's a ton of different websites out there, but I honestly, genuinely believe this is the best way to do it. And you don't have to have the premium version for this. They have two options here. They have a stock screener and they have an ETF screener. The stock screener is a little bit more comprehensive and a little bit more extensive in terms of what you can do. Go to seekingalpha.com, go to stock screener here. You can create a new screen, and then you're going to want to click on advanced filters. And what I like to do, and I'm just going to do this very briefly here for you to show you what I do. I go to the filters here and I look at the dividend yield forward. I look at the 4-year average dividend yield, and I look at the dividend growth rate and the years of growth. These are really, you know, when I'm screening high level for different companies that I want, this is what I'm looking at first. So I'm going here, and then what you want to do is you said that you wanted a company that has a, you know, a 5% dividend yield or higher. You wanted dividend growth of 6% or higher, I think you said. Let's just try 5% for now, just to get a thing there. Now, if you wanted to just screen for like dividend aristocrats or stuff like that, or dividend contenders, you could play around with this. So you see how that changed. Without any filter to years of growth, we got 247. And if we do 6 years, it brings it down to 23, right? And so this is what I do is I go over here to dividends. This is the best way, in my opinion, to do it for free, to screen for the different rates that you're looking for, right? So the forward yield is based off of the share price today and the current dividends per share. This is where you're going to see this. You're going to see the 4-year dividend average. I like actually looking at this because I'm usually dollar cost averaging into my portfolio. And then the other thing that I'm looking for is this right here, the dividend growth rate. So this is how I personally screen for individual companies. Now, another way so this does not show ETFs. To do ETFs, they have a different screen. And this is what I usually like doing here. I like going US equities, right? None here. all here, doesn't matter, whatever. You can do a dividend yield right here. The only difference here is they don't give you the growth rate. So what you can do is you can say, all right, I want to focus on low expense ratios. I want to focus on a high dividend yield, right? And then you got, let's do 3 here. You get maybe a few bigger ones. So for example, SEHD. SEHD fits the bill in terms of, well, it doesn't fit the bill for your example of the 5%, but this is how you can screen dividend ETFs. And if you want the growth rate, you're going to have to click into it, and you're going to have to go to the growth rate, and you'll find it there. So that's how I screen it. So there's 2 ways you can do it here on Seeking Alpha: the ETF screener, the stock screener. And as I mentioned, you have all access to everything with the free version. If you do want the premium version, I'll leave a link in the description below. You won't get a better price. You get 50% off if you use my link. I do benefit from it as well. Seeking Alpha, it is an affiliate link, so they give me a small thank you if you use my link to sign up. No pressure whatsoever. In terms of the premium for dividend investors, you have your dividend ratings, which is really cool, and you have your forecasting. So those are the 2 big things with Seeking Alpha Premium, and obviously all the articles that you can get there. So that is in a nutshell how I go about screening it and how I generally like to do it. There's a ton of different screeners on Google out there, but for me personally, I like Seeking Alpha because for a couple of reasons. It's all in one place. It's easy. I trust the data that they keep it accurate. A lot of other websites, like sometimes the data is not always up to date, which is kind of annoying. Yeah, I hope that, and also the last thing that I like is the way that you can carve it out and get really granular with your search. I really like that as well. But yeah, thank you so much for the question. I hope that helps. All right, let's take a look at the first portfolio. It's from David. He writes, hello, my name is David, and I just turned 18 years old, and I've been investing in crypto since I was 14 with my mom's help. And I want to start moving my gains into the stock market. I currently get a scholarship money to live off of, $1,500 a month, and another $1,000 a month from a part-time job. I have a starting capital of $10,000, and I'm going to add $1,000 to my stock portfolio monthly, as well as $500 into my crypto portfolio. As for my time frame, I'm looking to retire in anywhere from 10 to 20 years, but I'm really in no rush. I absolutely love it if you would take a look at my portfolio and give me your general thoughts on the crypto space. P.S. I'm binge watching. P.S. I can't stop binge watching your Review My Pies. Well, hey, David, thank you so much, man. I guess a couple of things, you're very unique. You're 18 years old. You probably have a really good, your parents have probably instilled this into you from a very young age about the importance of financial literacy. I think that's really, really great. You already have a starting, net worth, I guess, of $10,000 at 18 years old. That's absolutely incredible. When it comes to crypto, I'm not really the right person to talk about crypto. I can speak to it in terms of how I view it as a dividend investor. As a dividend investor, I focus on cash flow. Cash flow is over everything. All the businesses, all the investments that I own, it's not all based off of speculation or, the greater fool's theory, like who's going to pay more for the investment. It's based off of what does the asset actually produce. And so for me, as a dividend investor, until crypto is actually an asset producing something. Now I know there's stable coins, etc., but for me, the asset actually has to produce something. And you saw that here a couple of months ago with, where crypto has just been crashing. Where I am troubled by crypto is where's the floor? In general, investing in accounting terms, there's usually a floor, and it's based off of a book value or a price to sell, whatever. Where's the floor with crypto? And once again, maybe there's an answer to that, but I'm not the right person. I don't know. Maybe there's somebody smarter than me that can comment in the comments below what that means. I don't want, I'm not a crypto channel, but what I will say is I focus on cash flow and businesses that are profitable, that generate cash flow and pay me as a dividend investor in the form of, a growing dividend. So that's my take there. Let's take a look at your portfolio. I don't know why this is not showing up here. You got 9 slices, 26 holdings. You said 10 to 20 years. I like that. I think, 10 to 20 years. That's the beautiful thing about investing is your age doesn't matter necessarily. You know, the account type that you choose, that absolutely matters. But when it comes to your time horizon, how old you are doesn't really matter. You can live off of your portfolio when you're in your 30s and in your 40s and your 50s. So that's really, really important that you understand. So let's see here. Information technology, 30%, 25. Okay, let's pull this out here. If you follow the channel, you probably have heard me say this. 0.25 times 0.30. That means 7.5% is in Apple and Microsoft. Okay. Yeah, this is okay. I generally wouldn't go over 5% in one single company, but I think you're kind of at that range where it's like, okay, it's fine. Like I wouldn't like go crazy over here, but 7.5%, okay, that's fine. But yeah, generally I like to keep one individual stock more than, keep it less than 5% ideally. Healthcare. So the other ones here really quick, I think these are fine. You're going to invest in individual companies. Next 10 to 20 years, I think all of these companies are going to be around. I think you're going to be fine. Healthcare, AbbVie, Medtronic, Pfizer. This is really good. I like this. I like the Pfizer lower. I like AbbVie. I like Medtronic. It's a good blend of growth and value. Consumer discretionary, VF, okay. Starbucks, Nike, Home Depot, all equally weighted. Yeah, I think that's fine. Industrials, Honeywell, FedEx, 3M. You may want to consider reconsidering 3M. For your time horizon, like 10, 20 years, 3M is, it's grown very, very well in the past. With the spinoff of their healthcare business here next year, I think growth is going to slow in 3M. Okay, so that's something that you want to start thinking about. And that's the challenge when you invest in individual stocks. You kind of have to keep up with them and follow up with them. But yeah, 3M is growing much slower than a company like Honeywell. So something to definitely keep an eye on. Maybe there's a reason why you have 3M in here. Maybe you are a personal consumer of their products and you really like them. So be it, but just be aware that 3M is not going to be growing as fast. I have it in my portfolio, but my time horizon is like 2 years. So something to be aware of. T. Rowe and JP Morgan for financials. I like that. I like it. Good performance, really strong bank. T. Rowe is great. T. Rowe actually has amazing growth rates. Like absolutely amazing dividend growth rates. Really, really impressive track record. Materials, Ecolab, ALB, and PPG. Yeah, I like these. Materials. These are more growth oriented. I like this. I like that you're focused on these companies versus maybe like just a old school paper company that's growing at 2 or 3% a year. So I like that. Consumer staples, Tyson Foods, Costco. Okay, so what I would definitely consider, you're early in you're 18 years old, very tech heavy. Maybe consider looking at other staples that you like. Do you like Pepsi? Like, do you like Lay's potato chips? Do you like Target? Like, I would consider when you're first starting out, you're 18 years old, and this is for everybody, consider making maybe your second largest, like this is actually really impressive for an 18-year-old, by the way, but like consider or reconsider consumer staples because you probably have more visibility to the products in this sector. And when the market goes down, it's much easier to hold on when you see your portfolio down 30, 40% in a true bear market when you know the companies that you're invested in. Okay, so something to definitely consider. Every new investor watching this video, consider this, like really look into consumer staples and consumer discretionary as maybe some of your largest holdings, at least when you're starting out, right? Because this portfolio mix right here, this is great for like a 20-year time horizon, but this mix, the percentages are going to change in 10 years and in 15 years as you get closer to retirement. Right? So something to consider. Communications, Disney, Comcast, these are great. I like that you have like actual like growth companies in there. Southern and Exeter Energy, these are great. I also like Duke. Duke and Southern Company are really strong. I like both of them. Okay, cool. Well, David, hey man, this is amazing. For an 18-year-old, you are off to an amazing start. I think I get so, I don't know if the word jealous is the right word, but like I really, really wish that I was set up the way that you are on this path at already 18 years old, because the huge advantage that you have over me today is time. Time is the most valuable asset for anyone, and you are starting off in such an amazing position. The thing now is just focusing on understanding compound rates and making sure that you're keeping your costs low, looking to make more money, and really just sticking to the basics, and you're gonna be a multi-millionaire. So thank you so much for sending over your portfolio. All right, the next portfolio is from Victor. He writes, "Hi Jake, my name is Victor. I'm 30 years old. I think I put 32. Okay, so you're 30. All right. And I just met your YouTube channel and realized how insane your content is." Well, I don't know if I label it as insane, but that's cool. Hopefully you'll be able to review my pie in a video or even give me some feedback. That would be insanely helpful. Please don't mind my English. It's a bit rusty. No worries, man. Your English is great. So as the title says, I'm a Brazilian investor currently trying to build a passive income for the long period of time. I actually have 50K invested. I'm assuming that's Brazilian, which is almost $10,000. Okay, great. Yeah, the strategy for me is to invest 20% in the US. And my strategy is focused on dividend growth investing, but I also allocate my money only to great companies. It does not make sense for me to invest in a high dividend company if the same is not productive. Okay, cool. All right, so let's take a look at this. This is from another email that you sent. I think this is your updated portfolio here. You got AbbVie, Disney, Johnson & Johnson, 3M, Pepsi, Gamer. I'm pretty sure that's a gaming ETF. SPHD, it's a monthly dividend ETF, VTI, Apple, JP Morgan, NVIDIA, Procter & Gamble, NSC, I'm not familiar with, Linda, Nexar Energy, Costco, Coinbase, okay. VNO, I'm not familiar with VNO, WPC, VNQ, okay, VNQ is the Vanguard Real Estate ETF, Realty Income, and DOC. All right, cool. So first off, I like that you have all your individual companies at no more than 5%. I like that you have your ETFs at more than 5%. I like that. I think that's good. You got some Coinbase in there, maybe so rolling the dice. That's completely fine. Yeah, I mean, the companies in here, a lot of them are large, well-established companies. I don't think you can necessarily go wrong with it. I like that you have maybe your speculative or your, I like to call them your satellite positions, right? You got your core and your satellite. Your satellite positions, you know, maybe in a Coinbase are a little bit lower. I like that a lot. A lot of people, they think when they're investing, it has to be all or nothing. You can definitely have a growth portfolio. You can definitely have, you know, a couple holdings in there, or maybe speculative moon companies in there. But overall, I like it. I like your strategy. I think it's incredible that you're investing. Your experience in Brazil is going to be very different than somebody maybe here in the US. Your costs, your expenses are going to be lower, so you may need less in dividend income. The holdings that you have are good. I would make sure that you're focusing on companies and ETFs that you understand. And very, very important for somebody in Brazil, I don't know the tax laws in Brazil, but you're investing into a lot of US companies. Making sure that you understand what the tax laws are. Are you going to get double taxed? Are you going to have international tax being, from Brazil? So that's definitely something you want to consider. I'll give you an example. I, for that reason, do not invest into some international companies because of the taxes. For example, Nestle. I would absolutely love to invest in Nestle, but I'm not going to pay the 25 or 35% international tax. It just does not make any sense. Therefore, I would rather invest into Hershey's, for example. So the taxes definitely play a role in how you're building your portfolio. So make sure that you have that in mind. But yeah, this is great. Thank you so much for sending over your portfolio. All right, the last portfolio is from Scott. He writes, "Hi there, I want to start off by saying I love your channel, watch every video you post, and love your advice." Scott, thank you so much, man. I really, really appreciate you saying that. You can't see me blush, but I'm definitely blushing. But about myself, my name is Scott. I'm 35 years old, and I just started a state government job that will provide me with a decent pension. I currently have 2 rollover 401ks from a previous employer or employers that are just allocated to target date funds, around 35K between them. But I recently decided to start my own Roth IRA to gear more towards some tax-free income in retirement. At the moment, I do not have much to contribute monthly, which is why I have more invested into some high yield dividend ETFs, with plan to swap the percentage as the ETFs start paying out more monthly income to drip back in. The allocation percentage is kind of up in that I am trying to decide which stocks to weight higher than others. Okay, my plan is to be able to pull out 60% of dividends and keep dividend reinvestment on 40% at the age of 60, with the hopes of maybe getting 500 to 600 in cash out each month. Here's the link to my portfolio. Please pick me, and thanks for all the content. Well, Scott, thank you so much, man. I think you're in a really unique situation where you have a couple of things that you can rely on. You got your pension, you got your 401k, you're building out your Roth IRA, you may even consider in the future an HSA. Like, it looks like you're diversifying your portfolio in different account types. If you're thinking about these retirement accounts, you have to understand, that you're not going to be able to pull out this money until you're 60 without paying taxes and a fee on it. So it looks like your time horizon here is the age of 59 or 60. So that gives you a good 25 years. And your expectations here are very, very reasonable. This is actually really good, because I think most people are in a similar situation like you, where they're not making $1 million. They're not software engineers making $300,000 a year working at Google, right? They don't have a $1 million home with 3 cars. You're an average normal human being. You're a normal person by standards here that I would say here in the US, right? Which I think is great. What you're doing is exactly the right thing. You're investing into your tax advantage accounts. You're taking advantage of a Roth IRA. Once again, a tax advantage account. You're planning on having pension income in retirement. You're looking to supplement your expenses with dividend income. And I think this is absolutely feasible. I would highly recommend you play with the dividend reinvestment calculator. I just created a video here last week on that. I'd highly recommend you play with the numbers and see how much you need to invest over the next 25 years in order to get your ideal cash flow or passive income on an annual and monthly basis. So that's what I'd say to that. Let's take a look at your portfolio. And for whatever reason, I don't know why this is not working today. So this is in your Roth IRA. So your Roth IRA, you're not going to be able to invest more than $6,000 until you're the age of 55. So you're 35 now. So 20 years, you're going to be investing $6,000, and then you can do the catch up at 55. But let's take a look at this. Roth IRA, you have a high expense ratio, a high dividend yield. I already know what's in here without looking at it. You have a cover call ETF in here. Without a doubt, there's a cover call ETF. Let's take a look at it. You got Roth ETF, I'm assuming. Roth ETFs and Roth stocks. Who wants to bet that there's like QYLD or something in here? There's definitely a cover call ETF. Let's take a look. Oh my gosh, it's like I've done this before. So cover call ETFs, QYLD, JEPI, XYLD, RYLD, the whole works. You got Devo in here as well. Okay, so Scott, you're not going to like what I have to say, but I'm going to say it anyways. This is not the right approach. The math here does not add up. Unfortunately, over the next 25 years, you are putting yourself at a disadvantage. If you're investing like this, even though it's in a Roth IRA, right? You're reinvesting the dividends. This is all great. You have to understand what a cover call ETF is. A cover call ETF, it limits your upside. The calls, when these ETFs and the fund manager of these ETFs, when they're writing calls, they're limiting the upside potential. And so over the long term, in true bull markets, you're not going to get all of the upside. Yes, you're getting all this amazing cash flow from the dividend and you're reinvesting. But in terms of total returns over the next 25 years, you are going to handicap, if that's the right word, your earning potential. All right, so in order to better explain this, go over to my channel and I would definitely take a look at this video right here. QYLD JEPI. I would highly recommend you take a look at this video and watch and see if you're the right person or your time horizon is the right one to invest into QYLD. Okay, so this I really go through in detail and share the math behind investing into QYLD and who should consider and who should not consider investing into cover call ETFs like QYLD. Essentially, just to summarize that, if you don't have time to watch that video, you're limiting your upside potential, and by doing so, you're capping out your compounding, and over a longer period of time, even though you're reinvesting the dividend, you will come up short versus just the S&P 500. Okay, and so an alternative, what you could consider is potentially looking this is just an idea. You could potentially consider looking at, a broad-based ETF like the S&P 500 or VTI or QQQ. And if you invested into that for the next 25 years and then sold it in 25 years and then bought QYLD, you would be you'd have a significantly higher portfolio value. And at that point in time, you would have significantly higher dividend income. Now, I don't have a crystal ball, but that's really kind of the math behind these cover call ETFs. So if you have over a 5-year time horizon, cover call ETFs, not necessarily ideal. Now, in a Roth IRA, it's good because you're not being taxed, right? So it's not so crazy bad as long as you're reinvesting the dividends. But for you, 35 years old, 25-year time horizon, I would highly encourage you to reconsider this. So maybe not necessarily what you wanted to hear, but the math doesn't really lie. Now, once again, I'm using math from historical data, which is not a guarantee of future returns. So something to definitely consider. But here, let me go back into here. I like Devo. I like JEPI. I like QYLD. I mean, these are all really great, but just not for your time horizon. Okay, so that's that. Let's take a look at your stocks. What do you got in here? You got AbbVie, Starbucks, Realty Income, Johnson & Johnson. A few of these I'm not so familiar with. Some REITs, I guess. Stag, Pepsi, Morgan Stanley, Home Depot, Coca-Cola. These are all equally weighted down here. These are higher. This is a lot of exposure into one company. Do you work? You said you're a public. Maybe you work in healthcare. Okay, it's pretty high for one individual company, right? So, and I know that there are risks with AbbVie, right? With the Humira or whatever, the patent, I think, coming up. So, but yeah, your other companies are good. I like that you have Verizon at a lower amount. Essentially what you're doing is you're taking a blended approach, similar to what I do, is you have growth and value bundled together, and then you're reinvesting the dividend, and it's kind of building off of itself. I personally am not the biggest fan of having AbbVie be the highest here at 16%, right? Like for me, from a risk management standpoint, unless you work at AbbVie or you have connections with AbbVie, I personally think it's too risky. I think your average person would be better off spreading out this target allocation across these other companies, because it's just, for me, it's just unnecessary risk. If something were to happen with them, it's just not worth it, in my opinion. And also thinking about it over the next 25 years, did you make the right decision? Did you not make the right decision? I like going a little bit broader and being a little bit more diversified. But anyways, so I would definitely take a look at this. Take the feedback that I gave you. I hope that this makes sense. Don't just blindly listen to me. But yeah, absolutely do your own research. Don't blindly follow what some stranger on the internet says. But what I would highly encourage you to do is understand the rule of 72. Understand the growth rates, even with the dividend reinvested, of QYLD and others, and then understand how quickly are they growing? What percentage are they growing? How quickly will that investment double, even with the dividend reinvested? Okay. And so you've said that you've watched a lot of my channels. I've talked about this a lot. Understand the rule of 72, kind of rethink what your end goal is, and then go from there. So I hope that helps, but 100% I would definitely reconsider, or at least reconsider the allocation percentage and maybe take a look at that. Because in my personal opinion, let me share what I do. We're the same age. I'm 36 years old. In my Roth IRA, my largest holdings are VTI and VGT. So the growth ETF, the technology growth ETF from Vanguard, and the total US stock market. I also have a small, like 10% in VNQ and 10% in VXUS. VXUS is international ETF. But the overwhelming majority are in VGT and VTI. And my plan is, in 25 years, I don't know what the future is going to hold in 25 years. I'm not going to pretend that I do know. So I'm going very broad, more growth focused. And then in 25 years, in my Roth IRA, I'm going to see where I'm at in life. I'm going to see what my expenses are. And then I'm either going to buy something, buy a house, for example, or some other large expense, or I'm going to sell them. I'm going to buy a ton of, Coca-Cola stock, or another company, or SCHD, or QYLD, or JEPI, right? But my portfolio balance will be significantly higher because of the compounding over the next 25 years. And that's what I'm considering. Now you can consider something similar or something completely different. But the key thing here is understand growth rates, understand the rule of 72, understand your risk tolerance, and make the decision for you. Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you learned something new. I hope that maybe, there's a new investor here that's watched this video and that gave them a new idea of something to maybe reconsider. That's what I'm hoping for by creating these YouTube videos. I really want to help and, spark new ideas and share some things that I've experienced, I've learned. But ultimately, I hope that this was inspirational. It helped you in some way or another. And thanks for watching. And I'll catch everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.